Hey there, I'm Justin Spicer from Legal Aid of Southeast and Central Ohio, and I'm here with Kathy Hoover and Melissa Skilleter, attorneys with Lasco's Low Income Taxpayer Clinic. Today we're gonna be continuing our small business series, and we're gonna talk about record keeping. So feel free to leave a comment below, and we'll answer whatever questions we can. Kathy, can you get us started today on why record keeping is important?
Yeah, so everyone who works for themselves needs to keep track of records to show how they figured their income. Good records will help you keep up on the progress of your business, prepare financial statements and tax returns, identify where your income is coming from, keep track of your deductions and expenses to back up what you report on those tax returns, and can keep track of what we call basis in property. Basis is just a fancy term for the amount you pay for your property minus any depreciation you may have taken. The IRS can go back many years and audit your returns, so keeping good records and being able to prove what you report on your tax return is especially important.
So Melissa, what records should I keep?
The type of records you need to keep for federal taxes depends on the type of business you run. Your record keeping needs to show your gross income, which is your total earnings before tax credits, and deductions. You should also keep records of those tax deductions and the tax credits.
So Melissa, can you explain what a deduction and a tax credit are? Are they the same thing?
No, they're two different things. Deductions, also called expenses, reduce the amount of your income before you figure out how much tax you owe. Deductions or expenses are the things you pay for to carry out your business, like your electric bill, your other utilities, rental payments, internet bill, office supplies. Tax credits, on the other hand, reduce the total amount of tax you owe or increase your tax refund. Some credits are refundable, meaning that you can receive a refund even if you don't owe any tax, but many are non-refundable, which means you can only reduce your tax you owe down to zero. For more information, visit irs.gov/credits deductions/businesses. You can also go to the IRS website and search for business deductions. You can also find our videos we have posted on our YouTube channel on these topics. Documents to back up the deductions you can claim include account statements from a lender to show the interest that you paid interest, canceled checks or other records showing proof of payment, detailed debit or credit card receipts or statements, and invoices you've received from vendors, packing slips, contracts, and leases. It's important for the document to state exactly what the expense was rather than just showing the end amount due.
Kathy, Melissa mentioned that you should keep records of your gross income. What kind of records should I have?
Yeah, so you should keep any and all documents which show the income you make from your business. Documents can include things like copies of cash register receipts, deposit slips, invoices that you've sent to customers, bank statements, Venmo, Cash App, PayPal, Zelle, or other types of payment transaction histories. And those year-end statements from places like Uber, DoorDash, Instacart, Twitch, or Instagram are all things that you should keep. In addition to your income, tax records, tax credits, and deductions, if you buy items to resell, you also want to keep track of your purchases, meaning the items that you buy for the purpose of reselling to customers. Records for these types of items are the same as for the tax credits and deductions. So you want to keep things like checks or other documents showing proof of payment, credit card receipts and statements, and invoices, like I mentioned a moment ago. Most importantly, if you drive your car for personal business, I'm sorry, if you drive your personal car for your business, you should also keep a log of all of your mileage, not just your business mileage. So you can add up at the end of the year the business and personal mileage and deduct those business miles. You should always have a log available to prove to the IRS your business and personal mileage. If your car is used solely for your business, you should still keep a log of all of the miles driven in case the IRS wants to back up your deductions. Stay tuned to a future Facebook Live on this topic.
Other records you should keep, in addition to your deductions or expenses, income, and tax credits, are for your assets. Assets are what we call the property, such as machinery and furniture that you own and use in your business. You need to keep records that show how and when you got the property, how much it cost, the cost of any improvements, and whether you previously took any depreciation deduction on the property, and how you use the property in your business. If you sell the property, you also need records of when and how you sold it, the selling price, any expenses involved in the sale. If you would like to learn more about depreciation, please check out some of our other videos on our YouTube channel. As you can see, this is a lot of information to keep organized. Some businesses choose to use electronic accounting software programs to keep and organize their records. But you can also keep track of your transactions using actual hard copies of receipts, invoices, bills, and so on.
So Kathy, what if I operate a business where I travel a lot? What records should I keep in that case?
So if you travel for your business, then you need to keep detailed records that show the cost of each separate expense for travel, lodging, and meals. You also want to keep records of expenses for things like taxis, fees, and tips. You will need to show that each trip you took had a business purpose. You also need to show the dates you left and returned for each trip and the number of days you spent on business. Or instead of using the actual expenses, you may be able to use the per diem calculation provided by the federal government. Per diem is just a fancy Latin word that simply means by the day or for each day. You can find this information on their website at gsa.gov/per diem rates. And that's PERDIEMRATES, or you can do a quick internet search of those words. After you look up the dates and locations of where you've traveled to, it will give you a per day amount that you can use for your travel expenses. You multiply that amount by the number of days you've traveled to get the amount you can deduct. Please keep in mind that in general, any expenses for personal entertainment or travel expenses of friends and family members who join you on business trips cannot be deducted.
Okay. So how long do I need to keep these records, Melissa?
That depends on what the document records. You should keep your records to prove an item of income, deduction, or credit that you reported on your tax return until the period of limitations for that tax return runs out. So generally, that means you would keep your records for 3 years from the date that you filed your tax return or 2 years from the date that you pay the tax, whichever is later. If you have employees, you should keep those records for at least 4 years. Even when your records are no longer needed for taxes, don't throw them away until you check to see whether you would need to keep them longer for other purposes. For example, your insurance company or lenders may require you to hang on to some of these records for longer than the IRS does.
Okay, great. Thanks for tuning in, TaxBots, and thanks to Melissa and Kathy for the great information. For our next self-employment segment, join us in October. We'll be talking about tracking mileage for rideshare and delivery services like Uber, Lyft, and DoorDash. And remember, this segment and all the others in our Tax Chat series are available on our YouTube channel at legalaid.sco. Thanks, everyone, and we'll see you next time.